Good evening. Good evening, everyone. Big warm welcome. Good to see you, Leon. Nice to have you with me. I recognize a few of the other names as well, so a big warm welcome to all of you. My name is Adam from Trade with Precision, and tonight's topic is how to spot patterns in the chaos. We're going to be using Fibonacci tools. And yeah, so just want to make sure, first of all, of course, that you can hear me and that the sound is good. I have green lights on my side. And there we go. Thank you. Thank you. So we have, what was I going to say? We've got a couple of risk disclaimers. I need to give you a moment to digest that. For those of you who don't know me, I am based in the city of London. I'm on the tail end of a cold, which is why my voice is a bit rusty. Yeah, I'm not sure. Sorry, I used to be doing one or two of these a week, and I'm not sure why, but lately I've been on holiday, I've been away, so possibly that's why I haven't been attending or speaking on as many webinars. So just so you know, no, I'm always going to be here. I'll let you know if that's ever going to change. So ladies and gents, yeah, I'm based in the city of London. I'm a technical trader. I predominantly day trade these days, which is interesting because I used to do more end of day stuff, but I do more day trading lately. And we're going to be covering a lot of those topics today. So on the agenda, we're going to talk about understanding how Fibonacci tools help identify entry and exit points. Then using Fibonacci tools in your trading routine, and then we'll do a live demo on the platform. Now, I have both platforms up. I have both the browser platform and the MT4 platform. So if you have a preference, just let me know. Otherwise, I'll do it on the MT4 platform, but I have got both of them up. So let's just see what else we got here. Okay, fine. So here we'll go across to the platform. But now, before I do, I want to kind of lock down a few core basics about technical analysis. Okay, so that we can we understand how the Fibonacci measurement fits into it. So here's essentially what we're going to do. I'm just going to pick a color here, just go through this. There we go. So there are essentially two types of market conditions. Now these rules apply to all markets, all time frames. So it doesn't matter whether we're looking at cryptos or stocks or commodities such as gold, or whether we're looking at currencies. These rules apply. You can any market on any time frame can only exist in one of two states. So that means that it is either, let's say, not trending, which means it's mixing up its highs and lows, and it's not offering any clear direction, or alternatively, it is trending. So it's trending up or it's trending down. Okay, so those are the only two states it is, not trending or trending. So the way we view it as technical traders is if it's not trending, we don't believe there's any money-making opportunities to be made in these situations because, first of all, sideways markets tend to have lower volume. Fewer traders get engaged in them. Trending markets tend to have more volume, and that's part of the reason the market's actually moving. There's more money pushing the markets, and so it's actually more active, and it attracts a whole lot of trend-based traders. So sideways markets, lower volume, a lot more noise, very much like a tumble dryer that's going to kind of sort of eat you up and chew you up and spit you out. And then we get the trending markets, trending up or trending down. Okay, so if we know that the market's trending up, we've got the option of buying. If it's trending down, we've got the option of selling, and we want to be able to get into that. So that creates this. There's then only three different ways you can trade the market. So only three different types of ways to trade the market, to oversimplify. And I'll start with the number 2 one first. If you find a range, you have the ability, you can buy at the bottom and trade it up to the top. Okay, it's not bad. Put your stop loss on the outside. You can get some relatively decent reward to risk. The probabilities here are mixed. They're not bad. They're not great. They're just kind of okay. But you can get some nice reward to risk setups here. And yeah, it's tradable. You can do that. You can sell from the top, trade it down to the bottom. You can do that as well. So that's the second way traders can trade market conditions to make money. The third way, which is the least successful way of doing it, but it seems to attract a lot of people who think it's a good idea, is to trade reversion to the mean. So reversion to the mean is when the market goes away and then tends to come back to an average, goes away, comes back. And so traders will attempt to trade it against the trend. So the trend is to the upside, they'll be trading against the trend. And this is not it's not a great approach for several reasons. It's an inverse reward to risk, usually meaning you're risking 1% to gain 0.5% profit. You're going against the trend. It's very stressful. It's very stressful. It's very tricky to work out where your stop loss and different things should be. So it's not a very sensible way to trade the markets. And then you have your third option, which is number one, which is the winner over here, which is to trade with the trend. And the same thing here, you're, instead of waiting for price to be overextended and trying to trade it back to its mean, is to wait for it to get to its mean and then trade it in the direction of the trend. And this is usually the least stressful. You're trading with the movements of the market, and you usually have a relatively sensible stop loss, and it's usually a nice reward to risk ratio of 3-to-1 or 2-to-1 or 4-to-1 on average. And so it's and it makes a lot of sense. You feel like you're actually engaging in the market the way it's supposed to be going. So instead of trying to convince yourself the stock market's always trying to crash, when they're going up, you're trading them to the upside, and when they are crashing, you're shorting them to the downside. So you're more in flux with the market instead of constantly trying to find an argument as to why you're being proven wrong. So so those are the three different ways in which you could, your strategies. And so, for example, if we're trading with a trend, we could wait for a pullback. So let's just say that we have moving averages. Price comes back to the moving averages. We could look for an entry opportunity there, trade it to the upside, or we might find, for example, that there's a bit of a consolidation, like an ascending triangle. And so again, the moving averages are sort of coming up here. And again, we could look for an entry there, stop loss below that, and target 3-to-1 on a flat level breakout. So a case in this one, for example, would be Swissy yen, which is a nice little breakout. So let's go and have a look at that very quickly. So what we actually have here is a little bit of a flat level that has formed over here. We've got a series of lower highs coming into this, looking nice and bearish, and eventually we've seen the market has actually managed to break out. So today we've got a breakout to the downside, and it's looking nice. And we actually had the inverse over here, which is quite interesting. We had another one here. We had a series or a breakout to the upside there. And so there's something I really want to highlight here. We're not, guys and girls, we're not talking about investing here. We're talking about trading. And it's crucial that we understand the difference between trading and investing. Investing is generally, I'm going to oversimplify it, but it's generally true. It's generally a buy and hold approach. You want to put your money away for a long period of time, and ideally over that period of time, it's going to increase in value. Your investment will increase in value. Trading, guys, is not at all like that. Trading is a short-term move in the market. And it comes with an exit. You absolutely have to exit the trade and bank the profits. So you're going to be in and out of the markets more frequently. You know, you could be trading on the daily, so you might still be in a trade for a week, but there is an exit point. And I want to illustrate how people who don't apply the difference pay the price. So in this case, they see a breakout to the upside. So how would we normally enter it? We'd get in above the high of this flat level. We put our stop loss below the most recent obvious swing lows, which is over here. Yes, I could put my stop loss there. I could also put it there. I could also put it there. All of those are valid, but this one is probably the closest, most reasonable place for me to put my stop loss. And then I'm going to target, say, 3-to-1 on this. So I might just have hit 3-to-1 on that trade, and then the market ultimately reversed. So when we're trading, and this, please take notes of these, or just remember what I'm saying to you here. When we are trading, we do not expect the market to go on in perpetuity after we are in it. It is not an investment. We're not expecting the market to keep going. We anticipate that there's a high probability the move we are expecting will happen. And after that, we allow for the fact, really important that you remember this, we allow for the fact that that might be it. The market might hit our targets and then change direction entirely. So why is that? Well, because this is how the market works. The market works off price. Before there were charts, before there were computers, going back 100 years ago when you were still in the pits as traders there, the market would move from one level to another. So you'd be sitting in the pit watching the price of gold go from $900 to $925, for example. And so if price managed to go to $920, $901, then it would probably work its way up to the next high that it was at previously, which is $925. And then if it came back down, maybe drop below 920, then it was reasonable to expect it to work its way back down to the last major price level. So that's really all that happens. We've got all these complicated indicators. We've got all these complicated indicators these days. But back then, you just watched price in the pits, just price, the market going from one price level to another. So I've got to let my dog out. Excuse me 1 minute. So, and that's really what it was. The market would move from one price level to another and then back down, or it would break through and then go up to the next price level. And that's essentially what the market still does today. It still does it. And it's still fundamentals. It's still fundamental investors placing their buy orders and sell orders. But what we can do as technical traders is we can visually see where those price levels are, and we can visually read the story as the market is doing what it's doing. So it's not, it doesn't have to be too complicated. If we're making it very complicated, that's not a recipe for success. So the reason I bring this up is that we've got these previous levels here. You can see where the market is held at certain levels. There's a nice little level. We broke through it. What worked in this case was a nice little entry there, taking some profits there. And if we were lucky, we hit our 3-to-1. And then actually in this case, we've got something similar. We've got a break below this level. So there's a level here. Stop loss could be there, and I want to target a 3-to-1, which puts it kind of down here. Or potentially I could find a tighter entry on a lower time frame, which changes my 3-to-1 target, which actually reduces the risk, because the probabilities that the market is going to move is still the same. It doesn't matter where my stop loss is, the market's either going to move or it's not going to move. So if I can get my stop loss in closer, then that brings my exit point closer. That is trading. Really important. So we have to exit our trades. It's not an investment. And so what's interesting about this was we had a move to the upside, and then immediately it looks as though we've pretty much got prepared for a move to the downside. And once you accept that the moves might not go on forever and that you capture your profits and exit the trade, and then move on with your life, you will be a lot happier as a trader. First of all, because you're banking profits and not leaving stuff on the table. And you realize that it's about going out every day and catching fish. Okay, now my other dog wants me to let her out. So give me a second. She wants to follow her sister. Okay, so that's a really important thing, because if we don't take that approach through, we will lose money. Okay, and let me just do this one at the back door. Okay, so how does Fibonacci feature into all of this? Okay, so let's start with what is the most important stuff on a chart. Like if we had to strip it away, what would be the most important things? I'm going to go here. I'm just going to clean up the chart. That especially count on it. We don't need these. We don't need them. They're not important. There we go. So we end up with a chart that's essentially made up of price, and we have these price levels, and we'll use gold. We'll use gold because everybody knows gold, as in we're all familiar with it historically. And it has major price levels. It's got, and the interesting thing is they're predominantly round numbered. So we've got some that occur at around about 1,700. We've got some stuff here at $1,700. We've got $2,000 per ounce. We've got 1,900. Let's have a look and see. So often there's this reaction against just pure round numbers. Okay, and that's possibly also because we've, gold has been with us for so long that that's kind of just how it operates. So it often tends to have for the most part, most of these levels operate there. So again, we have got support resistance levels, which are the price levels that we've identified, and we've got price action, what it's doing. So if we look at it on a daily basis here, what is our trend? So I spoke about there's only one state that your market can exist in. This will all be tied together in a moment. So there's only one state that any market can exist in at any one time. And actually we can see what it is if we look. You start with where price is now. So price is here right now. And then you look to identify the major swing lows and swing highs. So there's a really nice swing high here. There's a bit of a swing low there. You can see there's a bit of a swing low here. And actually, if you look, there's actually another one here. So there's actually a move where the market has gone from there up to there, back down to there, and back up. So currently, we're in an uptrend. And I say we're in an uptrend because there's a lot happening. We've broken above this high. Okay, so that means we're not just ranging. We've broken into a new high. We're testing a bit of a level now, but the next major level that I could see was kind of up here. So we're probably going to work our way up to that next level there. And you could see that we had, we had a low here, lower high, and then a low and another one. And so there is what appears to be an uptrend in place at the moment that's happening. And so we have that trend in place. So that means that we would be bullish. We'd be looking for buying opportunities on this. And it's interesting because now we can see this on the daily. If I go straight down to the 15 minutes, you can see that on the 15 minute, we've had a nice little uptrend. We had a bit of a consolidation. Then we had another bit of a move. And now we're battling with a bit of a level here, just past $1,800. So call it 1802. We're battling a little bit to that. I'm going to put the line there. We're struggling a little bit because we've had a big move up. But the point is the direction is to the upside. Let's go look at that on a 1 hour again. We've got that. Yeah, it's a bit overextended, but it is more or less trending to the upside. And this trend is intact. This is really important how trends work. All of this will be tied together when we talk about Fibonacci. We have an uptrend that's made up of low and a high and a higher low and a higher high. And we can put our stop losses behind these points in a downtrend. Put my stop loss above that point or above that point, because in the past when the market has attempted to go to that point, the sellers have stepped in and pushed the market back down. So that's really a market structure that we're looking for to hold. And it's really only that if the market breaks through that, then the sellers that were there before aren't there now, and therefore our stop loss is basically, the logic is that you want to get kicked out of a trade as soon as you can confirm that it's not going to go your way anymore. So understanding where to put your stop loss is you can be trained how to do it. It's not something you necessarily figure out yourself, and it's always a good idea to have a stop loss. Almost all the best traders I know, and if you are sort of, I'm sorry, my dogs are now want to get back in. No, they can just stay out. So if you read Jack Schwager stuff, they'll almost always tell you their biggest losses came from not having a stop loss. So we have to have it in place. The question isn't really about having it or not having it, it's about where we should put it. So let's just say that I was impatient. I mean, the best time for me, we have what's called a push phase. That's when the market is already moving, and you can have a correction phase. So you get this kind of push phase, correction phase, push phase, and then you get a micro version: push phase, correction, extension, retracement, extension, retracement, extension, and now you get a temporary downtrend, and then it's back into an uptrend. So this is all normal. These are all normal breathing in and out within the bigger trend. And so ideally, I would wait for price to come back. So I wouldn't want to buy on a push. I would wait for the market to come back to pull back, to do another retracement and look for an entry here, or possibly it could come all the way down here and I would look for an entry here. So that's hard for you to do in the beginning because you struggle to find trades, and then you finally find a trending market and you don't have the patience to wait for it to come back. But after a while, in fact, not after a while, that's one of the first things you tend to get under control. You very quickly realize that you want the market to come back to these key points before you can look for a buying opportunity. And so where could my stop loss be? I mean, arguably, I could just get in now. It's not a good idea from a risk perspective. A lot of the move has already happened. But I'm arguing, I'm saying, look, I could do that, and I can put my stop loss there, or there, or there. This would be the best place probably because it covers this entire move. That would sort of be valid, that would be the best one. If the market came back through there, then I should definitely get out anyway. But the problem is that I've kind of left all this profit has already happened. So the next best thing would be for me to wait for the market to come back and then come back to a significant price level if possible, and then look for an entry signal. Okay, hopefully that makes sense to you so far, that what I've said so far. So how does Fibonacci come back into this? So we've got price action, support and resistance levels. You could argue trend lines. You could say, well, what about a trend line, and try to kind of say that, you know, that was also something. Yeah, sometimes trend lines work, but I would rather that we talk about, you know, what's the least that you could trade successfully with, rather than having 50 different indicators on your chart. Death by 1,000 indicators. That's a great expression from Larry Williams. So here's the thing. We know that price would come back to potential levels. I'm just going to clean something up here, clean this all up, and I'm going to draw in a few places where price could come back to. So you can see here there's some really nice exhaustion. So that could be one area where price could come back to. There's also a few others. There's also something over here as well. I'm going to put that in. There's definitely an area here where price could come back to. And of course, it's not impossible. It could come back a little bit further, come back into these areas here. So there's, you know, I think it's unlikely, but, you know, it could possibly do that. So there's a couple of areas where price could pull back into. You can actually see over here as well. I'll just put that in. You can see there's something there. A little bit of resistance, support, and resistance. And we want to pay attention, guys, to areas that have been touched from both above and underneath, because that means it was significant to both buyers and sellers. And look at this beautiful engulfing candle. This candle that engulfs almost all these, wow, all of them. Engulfs about 6 or 7 or 8 candles there, and it closes to the upside, and it's basically a solid breakout candle. And then it takes off. So where does Fibonacci come into this? Well, Leonardo Fibonacci was a mathematician. I think he was born like 1000 AD or something, about 900 odd years ago, almost 1,000 years ago. And he was a fantastic, talented natural mathematician, in the same way that Leonardo da Vinci was talented and natural in every other way. But this guy discovered that there were these repeatable patterns in nature. So if you haven't heard of the golden rule, if you haven't heard of Fibonacci sequences, you're about to hear a little bit about them. Essentially, and they are absolutely fascinating, he just discovered that there are these repeatable patterns within nature. And they're everywhere, from snowflakes from snowflakes to the horns of a ram, to the wings of a butterfly, to everything. Okay, proportions. And that's really what it comes down to. There are proportions in nature that are there as a result of evolution. And so basically, essentially, there were a couple of traders, 2 traders, I forget their names. They decided to see if these proportions, Fibonacci proportions, existed in the markets. In other words, if we had unconsciously we were repeating these proportionate patterns. So here's a couple. So one of them, for example, is if you take 0 and 1 and you add it together, you get 1. If you then take 1 and 1 together, you get 2. If you take 1 and 2 together, you get 3. So we're adding the previous number. So 2 and 3 becomes 5. 3 and 5 becomes 8. 8 and 5 becomes 13. Then 21. Then 34, and so on. So it's kind of just adding the previous number to it. And then there were certain things that happened. So if you took, for example, if you took 34 and you divide it by the previous number, you get, and I'm going to do this with a calculator so that you can all see this in real time. So what would happen if we did that? Take 34 divided by 21, we get 1619. So I'll put that in. It's 1.619. And I'm going to do it again. I'll take 8, divide 8 by 5. So I'll just take that and divide that by the previous number. And again, if you already know this, I don't mean to offend you. It's just for the benefit of those. And we get 1.6. And I'm going to do a third one so that we can see the difference. So I'll take 21 and 13, just because I want bigger numbers. So let's take 21 divided by 13, 1615. Okay, so basically we get they tend to work around 1.6. That's really what they're really working to. It's almost like pi. As we get that, it gets even more interesting. If I now take 34 and divide two numbers on as well, we also get proportionate figures there. So let's try 34 divided by 13, and we get 261. Okay, so that we're now doing a different thing. We're now saying we'll do a whole lot of them. We'll do 34 divided by, well, not a whole lot. I mean, I don't want to do this forever. 34 divided by 13 gives us 2.6 was it? I'll check that out again, and we'll do another one. I'll do 8 divided by 3 and see what that comes out to. 261, and then we'll just do 8 divided by 3, and we get 266. So then that tends to go towards 2.6. So there's these proportions. That's all it really is. I mean, it kind of is obvious when we add them up like that, we're going to get these proportions between them. I'm curious, what would happen if I took 21 and divided that by 34? So if I do 21 divided by 34, and I also do 8 divided by 13, is there a sequence that starts to show up? So let's see, 21 divided by 34 gives me 0.61. And if I had to round it up, I might do 0.618. And 8 divided by 13 is 0.615. Okay, so there's a pattern that shows up here in all of these. It's funny how 6 always shows up in a lot of those. So you get 0.6, 1.6, and 2.6. And so really this is just to tell you about these proportions. And somewhere along the line, somebody decided to see if they showed up in the market. So here's kind of the logic. The question was that if a market did a move, it often tended to come back about halfway, before carrying on. So that's what we just call a midway or halfway 50% retracement. Okay, that's a 50% retracement. So if we count this as 0 and we count that as 100, obviously if this has come back here to 50, then that's a 50% halfway retracement. And if it came back 75% of the way, right, we'd only have 25 left over here. So that would be called a sort of a 75% retracement. And so they discovered that the market tended to have particular proportionate moves, where the proportion of this compared to the previous one, there were specific ratios. And that's really what it's about, ratios, the golden ratio. So how would we measure this? Well, first of all, we would go up here to our Fibonacci tool, which is listed up here, draw our Fibonacci retracements. And I'm just going to, for example, I'm just going to just draw it here so we can see those measurements. We have 0 to 100. And then as it goes back, or if it goes from 0 to 100, it goes up 382, which is a Fibonacci number, and 618, which is also a Fibonacci number. And then the halfway point, which isn't strictly speaking a Fibonacci number, but it's a natural midpoint, is 50%. So that's a Fibonacci number, that's a Fibonacci, and we would have that. So if we use this in practice, remember how I was saying to you, this would be a bigger move from there to there to there. And then you've got micro or macro trends inside it. And that's what happens. That's always going to be the case. So I'm curious to see if we measure from this low over here. Whoops. Just going to put that over there. And then I'm going to pull this up in line with the height of this. So the reason I'm doing this is because the move went up from 0 to 100 up there, and it pulled back towards the 618. Let's done this the other way around. Let's do it the other way around. Sorry. Usually don't do it that way. It didn't pull back 618. There we go. There we go. Came back almost to the 382. So usually, if the trend is strong, we would expect a shallower pullback towards the 382. And possibly if the trend is still quite strong but starting to slow down, we might get a deeper retracement. The point of this is that the 382 and the 50 and the 618 together guys, constitutes an area with those three levels where a healthy trend is likely to pull back to. it'll pull back to the area, but it's usually likely to come back to one of these levels specifically. So we can use it to help predict a high probability where the market is likely to correct to. And we don't always know it's going to come back to the 618. There are sometimes clues which one it's going to come back to, which I'll talk about in a moment. Instead, what we do is we watch what happens when the market hits that level. So when the market hits this level, and if it produces a really strong bullish candle, then it's not completely crazy, not completely ridiculous to think that the market is going to take off from there. Do I always take fib from the wicks or from price points and ignoring the wicks? No, I always include the where price has gone. Price absolutely went there, so that is the very upper edge of price, and that is the very lower edge of price. So in this case, we would absolutely include the wicks, yeah, because you need to know where the market went, and it did go there. And so yes, if that's the case, then that might very well be our move to the upside there. And where it gets really interesting is if a market, and this happens, sometimes you might find that a market will pull back to the 382, do a move, pull back to the 382 again, pull back to the 382. So it isn't always a thing, but sometimes we see that it seems to have fallen into a bit of a routine of pulling back to the same. It becomes self-reinforcing. And it's okay. If you're thinking that, well, I mean, isn't that sort of hokum if the market is self-reinforcing? No, it's perfectly acceptable. Any sport that you play, if you have to play against an opponent, if you're able to predict their moves because they have a habit of doing certain things, that's your edge. So if the markets have a habit of doing certain things, that's how we that's how we work around the market. And so actually the very fact that the market is self-reinforcing is fantastic. It's the best thing about it, is that it tends to do that. And so we're talking today about how we can identify these areas, because remember that when the market is going up, I want to pull back to identify a high probability entry point, because that's lower risk. It's high risk if I get in after the move and then the market starts going against me, then rather waiting for the market to do a pullback and getting in and taking off, going into profit a lot sooner. Even if it goes back from here, it doesn't have to go that far before I can get out. So it's still better for me to wait for a pullback to get in, because then of course you get into profit a lot sooner. And that takes patience. So that's where you hear about discipline and patience, is that patience of waiting for the market to pull back to certain levels. And so we can use Fibonacci to help identify these, but it's more than just that. Where we start to get really powerful is when Fibonacci levels tend to overlay on top of support and resistance levels. So let me just clear this up again. And let's pick something else. So let's go look at, say, euro dollar. Okay, so we've got euro dollar here. We'll just have a look at a few of these things and see how some of these retracements have worked. So I'm going to go ahead and just measure a few here. So here we can see there was a pullback past the 618, didn't really, it actually went a little bit further. There are a few other numbers in here. We tend to focus mostly on the 38250 and 618. And also while we're on that, we prefer using Fibonacci's in a trend rather than in a sideways market. So if the market's not really trending, we're going to find that it becomes unreliable. When it's really quite powerful is when we start to get those measurements. So for example, here we can see that from this low up to here, it pulls back to the 618. And there's actually a level of support and resistance there, which is a double factor. So in other words, we want, ladies and gentlemen, more than one reason to take a trade. Ideally, we want 3 or 4 solid reasons to take a trade. And this is 2. We've just found 2. So we've got a measurement from here to this high, which pulls back to the 618. And it is also clearly visually a support resistance level. So that's an extra thing. And also you can see here, we've come back several times. We came back here, hit it away, came back, hit it away, came back, hit it away. So that can happen. These, you need to see these as almost double bottoms in an uptrend. And so what else? I'm curious, what happens if I had to measure from this low up to this high? So now I'm taking a second measurement. And here, I like this, we get a 50 fib and a 618 close to each other. When they're visually very close to each other, almost a few points from each other, we would tend to call that a cluster. But where we really hit the payload is if there was also a support resistance level there as well. So if that was the case, if we had 2 separate measurements of Fibonacci, for example, and they overlapped very closely with a recognizable support resistance and maybe a round number, that would be payload. That would be really good because that tells us that traders who are using Fibonacci on different time frames and traders using support resistance levels and traders who are trading psychologically off round numbers are all likely to have put buy orders in that area. And therefore it would act as support. And if we then get a nice strong bullish candle off that area, we would then definitely be considering taking it. So in this case, though, we didn't get a support resistance level there. We got one over there, but we didn't get anything over here. So that doesn't really mean anything. But I am also curious now, if we have to move on, you know, what are the other retracements? So for example, if we move this to this low here, so I'm just matching this low here, and I'm up at this high here as well, we get that price comes back to that 382. So let's just zoom in a bit. Here you can see price moves up, comes back to the 382, and it goes up. So let's do it again. Let's measure from that low up to this high. So now I'm measuring from this high. There we go. From that high down to that low. But actually, I want to do it from the most recent one from there. So from this low to this high, and we can see price comes back down towards the 50 period and then takes off from there. And then I'm going to do it again. I'm just curious. So what happens if I put it up on this low and I move it up to this high here? What do we get? Price comes back into this area again, into what we call the sweet spot, and then takes off from there. Now, sometimes it's very precise. Sometimes you get a very specific action at that level. But you will reasonably, think about this, logically and reasonably, you will get a stronger reaction if there's definitely a support or resistance level there as well. And we can see we've had that. So it makes plenty of sense for us to do that. So usually what we're doing as traders is we're waiting for the market to reach a level. Then we want to see if the market produces a price action confirmation at that level. And if it does, then we'd be looking to consider taking the trade. So how would we consider taking the trade? I'm actually going to go back to gold because this was a real trade we took, which is here. Go back to our weekly. Do it back on the daily. And oops, other way. So this, for example, I'm just talking about the concept here. We had price come down to a level. So I'm going to let you in on a little tip. Some of the most powerful patterns that have a 65 to 85% chance of success are the traditionals. We have a bear flag, price comes down and then trades off, so that's a bear flag. That has a really high chance of success. We enter there, stop loss there, take some profit, we're out. You get a head and shoulders that has like an 80% chance of success. We break that, enter there, stop loss there, target 1-to-1 or 2-to-1, works really, really well. So basic stuff works so well. Double bottoms, boom, boom, double bottoms. Okay, so price comes down, breaks that high. Anyway, there's these different things you can do. Now, one of the patterns that I never really caught on that list, but it is a thing, is a triple bottom. So this is what you're seeing here. This is a triple bottom. The market comes back to test this, does it 3 times, and then takes off. So the first time it comes down, we see a very, very strong bullish reaction. Gold has been just trending down, and there's our bullish candle, very strong, and it takes off. But then it hits support resistance. There it is, and it couldn't quite break through it. Comes back down to this level, and the second time it does it, produces a similar sized bullish candle. It's a double bottom. And then it tries to take off, can't quite do it, comes back and produces a third reaction off that. And then we get the big move. So there were multiple attempts. This is a triple bottom. You can see the price candlesticks, they were great, and then it takes off. And this is where we are now. And it slices right through that level, no problem. But actually, look at that. Look how it comes back and produces support resistance. Look at how it comes back and produces that nice little bullish signal. And then takes off. So now we're talking about support resistance levels. We're talking about candlesticks, double bottoms, certain patterns. These are things that the market does like it's breathing, like we do breathing. It's just normal for the market to do this. Yeah, you could argue there's a bit of a triple top here. You could argue that. You could also get a double bottom or a double top in a trend. And not a lot of people know this, but this is a very powerful pattern. So let's say price comes down, pulls back, goes down. So it should be in a downtrend, but then it comes back up to this level, and then it takes off. So that is a double top in a downtrend. That's a bearish signal in a downtrend. Same thing on a uptrend. So you got price does this, pulls back, comes back here, starts to go up, then comes back to that level, and then takes off. And actually, when it starts coming down here, some people panic and they close out their trade. Comes back to that level on a double bottom. So you've got a bullish double bottom pattern in an uptrend. And nobody talks about that. It's a very powerful signal. So I wanted to kind of talk about how that happened. Now this is, and now I'm going to throw in some extra stuff. This is where the MACD on the RSI and divergence is incredibly powerful. For real, this is where they come in. This is where you would get help from those. So we're going to bring in, I'm going to insert into this. I'm going to just use the MACD for now. So fine, there's my MACD. So what is so impressive about this? Well, when we get the first touch, there's our first touch. There's our double bottom. So when you get that, you immediately see, I'm just going to mark it here, that it's trending higher. So your indicator has gone bullish, and you've got a bullish reaction here and a bullish reaction here. So it's a double bottom. Price comes back down and produces this bullish candle. So let's say that you don't know what the next candle is going to do. You don't know. But we continue, by the way, to trend higher here. So all of this is very bullish on the MACD indicator, and then manages to break above it. When it breaks above that, you've got a change in trend. So when price is going down like this, a change in trend is when you go from lower highs, lower lows, usually come and produce a high, low, high, high. And also you want to break above one of these ones. And so that's actually an upside down head and shoulders, but that's the story. It's going from a downtrend to an uptrend. And that's what happened here. It was in a downtrend, came down again because that was the last big high. So here we go. Downtrend, 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 goes down, can't go anywhere, tries this, changes, does a double bottom and changes direction, and then comes back and produces high lows, high highs. So there's a shift in momentum to the upside. Let's run through a few charts quickly and see what's noisy and what we can't trade. So let's look at dollar Swissy. No, dollar CAD, Euro GBP. So Euro GBP is quite messy and very choppy. I'd stay away from that. What about Euro Aussie? Also, so here's a tip for you as well. This little block of 6 or 7 candles in a row, it tells you there's nothing to trade there. So if you see this on the daily, you could just move right on. There's no trades there. Go to the daily, we just get choppiness. Remember I spoke to you about how there's different types of market conditions. Go to the 4 hourly, it's just a nightmare. You really don't want to trade that actually. If you just focus on trending markets, you'll be happier and less stressful and make more money. So we wouldn't be using necessarily, using a Fibonacci measurement here. It's ideal. It's really powerful when we have a trend. And we want to see if the market is coming back to a particular level for taking off. Again, here you can see that response to that 302 level, finding support. But this isn't the kind of setup that I would like to really deal with. I want to be using it more in a trending market. So which trending markets do we have at the moment? Let's go look at oil. Do a little bit of analysis, excuse me, on oil. Blah, blah, blah. What did I do with it? Here we go. So again, downtrend, generally trending lower, comes up here, a bit of a double top in a downtrend. Remember that? So we said we had a general trend. But look at this. We've also got a bit of a floor here. So if we go to the weekly, bullish candle, bullish engulfing candle. So this candle's bigger than the one on the inside. This candle's bigger than this one here. And what we're looking for is any kind of bullish divergence. We know, should the market break above this high, it's also support and resistance. There you go. If it does, we're probably going to get something like that. So this is what we're looking to see if this is going to be the case. If I go back to the daily, principally, we've got this goes down to there. I'll actually do it with a trend line. We'll measure that from there to there. Always does this. Okay, so we've got that trend line. And again, I want to just keep this accurate. We'll just do that. And here we are. So if we just measure from here to where price is, we've got some bullish divergence. Okay, the implication is, and it's not just there, we've actually had this bullish divergence going way back. So actually the momentum of this is trying to turn around. I wouldn't say it's going to turn around. I think that's not reliable enough to say that. I would say that we could see it's trying to turn around. How would I know when it has successfully turned around? In other words, which price point does it have to go past to confirm that? Absolutely here. But for now, there's a good chance that we will be able to go from there to there. That's a good chance. But definitely if we break above that, we're probably going to keep going up to here. Because it's shifting, this trend is trying to change. And sometimes that happens. You get a downtrend that goes sideways for a bit and then starts changing. That's kind of what we're looking at here. But this is a really nice clue. That second reaction, you actually had a rejection there, came down, another rejection there. It's desperately trying to turn around. Doesn't mean I buy now. I think that's higher risk. I think that's much higher risk. I would rather wait for a definite confirmation that it is going up. So I would prefer to see a higher low, something like that. And as soon as it breaks that and I have a confirmed uptrend, then I would be looking for an entry. This is higher risk. So you could take it, but you wouldn't want to put 1% on it. You would say, okay, I'll buy now, I'll put my stop loss there. I'm trusting that this is going to result in a change in trend, which there's not enough evidence for that. So it's a premature decision. It would not be a good trade to do that. You trend traders and traders wait until the price action is confirmed what they want. So we would be looking to buy when this goes into an uptrend. And if it comes back down here, if it comes back down below this and comes back and rejects, there will be selling. So that's why we want to wait for the market to give us that confirmed uptrend, so we know, okay, it's definitely changed direction. So Fibonacci can help us identify areas for pullbacks where we could get into a trend. And so here I'm going to we'll use the S&P. So let's go to the S&P here, and let's go kind of to the 4-hour as well. So in situations like this, it can be useful to identify where those pullbacks come from. Let's just clean up all these objects and measure Fibonacci. So I am curious. I'm going to measure one here, and I'll go up to this high over here because I want to see where that comes back to. It's support and resistance. There we go. And we can see a pullback. Very interesting to me that it touched on both the 382 and the 50 Fib. So it's much easier if you just treat this as an area, as that's the sweet spot where the market can turn around, and then just see how it reacts at each of these levels. It's a much healthier way to do it. Then let's go and see what happened here. So we went up to these highs, and I'm just going to move this up to either the most recent low, and you can see there that then touches on the 382. So it moves up from here, touches the 382, comes down 382, and takes off again. Okay, but you couldn't have traded this because that move was so big, so fast, so big. You didn't get a clue. So you couldn't have. Sometimes traders will, I'll be bullish, but I won't get the entry I want because it just takes off so quickly. So we have that. Let's go further down. So let's go down to say the 1 hour, and right now it's a nightmare because we've had such a big move and it's not really a great trend. I would prefer it if we had a really nice, sensible trend. So where have we had a nice one as well? It certainly makes more sense when we do it. Silver was looking pretty good as well. So let's go here. So again, we've got this move. I'm curious here. So we'll take just from the lows here up to this high, just to see what happens there. And here you can see price coming back into that 382, ultimately takes off. Let's do the next one. So let's take, I'm going to come up to this high here. And actually it's interesting, it touches on the 382 even though we have this measurement still down here. If I bring it up to here, it comes back down to the 50 Fib. Okay, so let's move it up to the next one. So let's go up to here and bring this up to the next high low, which is over here. So you want to measure on the most recent visually obvious swing low. And here it comes back to the 382 and it takes off. And here you can see that resistance is also support. You can see the market reacting to that. If we go down to the 15 minutes, you can see that reaction. Market comes back to that. So in many situations, we would wait for the market to come back to that. We would need to see a swing high. So in other words, I'd want to see the candles going up and then have started to come back down. And once they've started, then I would measure the Fibonacci from that high down so that I could identify where price is likely to turn around. Let's try it for something that's maybe in a bit of a downtrend. So what's happening here with, let's try some of these pound yen is bullish or bearish. Okay, that's a bit of a nightmare. Let's go up to, I mean, here, for example, again, interesting. Measure from that high to this low, we get this pullback into the sweet spot. And again, if we measure it from down here, from this low over here, price pulls back into that. So here, you can see price pulling back. That's 100% retracement. That's generally a sign that trend is not going to go our way as well. So this is just a mess right now for all of these different reasons. I'm curious about that one. It's also a 618 retracement. The 618 retracement is what we would say is the furthest that a healthy trend could pull back before continuing on. If it pulls back further than that, then the trend is not as strong. So that's why that would be our last sort of attempt on that one, or our last approach on that one. I'm curious as well, just to see these measurements here. So I'll go from this one to this high. So we see price pulls back here to the 50 fib. I'm going to go up to this one over here. So I want to measure that. Comes back to the 382. If I measure it from here, it just finds support on that 382. And again, let's see. Let's go up to, well, if we go up to the high there, that's also comes back to the 382. And if we measure it up to there, it comes back to the 50 fib. So they're more powerful. So Fibonacci is great, but I always find that it's better if I have identified support resistance levels as well. So in other words, if there's also visually a nice little support resistance level and that matches up with the Fibonacci, then I have a greater expectation from it. I'm just trying to see if there's something that has a really nice downtrend, like these ones here as well. This is now trending up. So we've got a lot of the things that are trending up now. This is interesting to me because this is a double bottom. So let's go here. You can see this is a true level of support and resistance. You can see resistance there, support there, struggle to get through there. Here you can see it's struggling to get past some nice support there, support there, support there. And this is a double bottom. Okay, slightly lower low, higher low. This is very powerful when you see this. Very, very cool. And it's broken above that. And it's probably going to come back into these levels here. So let's have a look at this from a Fibonacci perspective. I want my support resistance level. So this is me personally. I tend to want to put in my levels there. There may be one here. So I'll mark these two areas because I can see support there and I can see resistance there. I'll mark those as my areas. Then what I'm going to do here is measure from the lows, because now we've started coming back down. Measure from the lows up to the highs. It always does this. If you go past the thing, it doesn't like it very much. So there we go. So I find this interesting because these levels don't line up with Fibonacci at all. They don't seem to do that. I'm curious. I mean, and that's okay, that happens. You can see if I bring it up to these lows, so price goes up to here and there, then you can see how much it lines up with everything. So suddenly if I put it in here, where we had this high low, so come on, there we go. This was the market producing it, then they seem to match up a lot better, but that's not really what I kind of want to do in that one. I would really like it to be this one as well. But having said that, it appears as though these are reasonable areas for price to be able to pull back into those areas. So what I would be looking for is going to be some nice bullish reactions there, and it could. I could even find that it comes back in double bottoms. So again, guys, if that happens, it's the second time around is just as good. Let's see if there's any other things. We'll do one more before we wrap up. Okay, so again, we've got these moves here. I like to throw in the moving averages as well. So the moving averages will give me also a good little location. So in other words, that is a good area for me to also find a potential turning point. And so I'm curious, if I measure from here down to here, what do we get? So from here, come there, price comes up, taps the 618, carries on down. So let's do the next one. Down to this one, and bring this one to there. So from this high down to this low, comes back up to the 382, carries on down. So let's measure the latest one. So we go to there and bring it to this high over here. Price is already back in this area. So this is already an area where it could potentially find resistance. I notice there's also a bit of support resistance here. That could work. There's also a little bit of resistance where we are here. And so this area is going to be the one that I'm really going to be paying attention to, but probably more so where there's a more significant price level as well. And what would I then be looking for? In this case, I would be looking for sell signals. I'd be looking for a nice bearish candle, something like this, a nice rejection of the wick, nice one like this, very nice closes off that. Something like that would be very nice to then see that move head to the downside. So I'm curious about that. So how would I go ahead and do this as a trade? I'd usually be waiting for that particular candle, but if the market is going to head lower from here, then one of the things I could do, have I lost it now? I have to check. Okay, I'm not going to, because of this. Sorry, there we go. Do I have this as a preference somewhere? For example, I'm just going to do my stop loss as red, gold, I don't know, red, entry, line. Just do this quickly. Stop loss, red, gold. I thought I had this as a preset somewhere. Stop will just be red, something like that. I'm also going to make sure I can put 2 trades on this one. So I'm going to take 2 trades here and make sure that I can see certain things. So here, I can see what my orders are. So I want to go short. So I want to sell. I want to put my pending order in. So here I'm going to take my entry and move it down below these lows because I'd be expecting price to head lower. And I'm going to put my stop loss. Usually I'd wait for that price action signal so that I could put my stop loss above the high. So in this case, what I'm going to do is I'm going to just put it here in case we're getting a double top. We're going to have price come back up, find resistance, double top, and then carry on down. So I'm just going to put my stop loss just above that high there. My entry just below some of these candles here. So if the market turns around and heads down, and then I'm going to take some profit here. So we've got, I want to, and then I'll wrap up, guys. I want to see this one. So draw, dip. This is a free one, by the way, that you can get from Earn Forex. If you go here, you can pick up position size calculator from earnforex.com. It's free. It's very cool. So do this there, and that's it. So now I can see what's going on. And so we got 90 points to my stop loss. So I'm going to set my first target at 90 and my next one at 270 or something like that. Or let's just do this one at 90. And we'll do this one at 270. So it's a 3-to-1 on that one, for example. And so what that's done is that's set a final target down there and a 1-to-1 target over here. And I'm going to run the script at 1%. Okay, so 1%, I'm just going to run it. And that's it. That's my trade is now done. It's set up as a pending order. You can see the candles now starting to look more and more bearish. Look at that, how that one was bullish. Oh, and are we in on the trades? Let's see. Are we in on the trades? Not yet. Okay, but if it's going to continue down, it's going to trigger me into the trades. So that was actually the candle I was looking for. While I was busy faffing around and placing the order, that was actually the thing that formed. Now we're going to see if it's going to follow through and keep going. Okay, it's a 5-minute window and we wrap it up. We're over time. So let's see what happens with that if it does continue down. We're going to see if that's the case. In the meantime, let's go back to this. All right, so, oh, there we are. We're at the end already. So really what I would like you to take away from this today, I won't, I promise, thank you. I miss the webinars. I really do enjoy them. I'll make sure that I am in more often. So thank you very much. And yeah, I was in New York. I was on holiday and I had a cold and it was just ridiculous. I couldn't do my 90-minute video. It wasn't an option, but it'll be back up this weekend. So thank you very much, Leon, and it's always good to see you. So one of the things I'd like you to take away from this today is that, look, we don't just take a trade off one thing. The Fibonacci tools are very reliable, they're very good, but they are much more powerful when they overlap support resistance levels that we could see, and when we actually have an idea of where we expect price to go. Is it going sideways? Is it trending up? Is it trending down? We find that if we use it in trending markets, it's much more successful. And then to not always have a fixed rigid rule, we're saying, look, between the 386 and the 618 is a zone. There are 3 levels in there. It could turn at any one of those 3 levels, but anywhere in that area is acceptable and fine for price to turn around. And then we start to watch and see how the candlesticks form in those areas and what happens there. Okay, so that's really what I'd like you to take away from this. It was an absolute pleasure. I usually am doing one of these a week, and I've only done like 1 or 2 in the last month. But yeah, if you need any assistance with your accounts or with the platform, please get in touch with the lovely folks at IC Markets or follow them through on social media. Otherwise, me being Adam from Trade with Precision was an absolute pleasure to have you. So thank you very much, ladies and gents. I'm going to end the webinar now, and it's going to kick us all out. Go and have a great rest of the evening and spend some time with your loved ones. Thank you very much.